Okay, welcome to this explainer. Today, we're putting on our expert investment analyst hats to look at a really fascinating case study in the healthcare sector. We are going to run Avanos Medical, ticker symbol AVNS, through the ultimate valuation funnel. Basically, we want to separate the market hype from the cold, hard numbers. If you follow the medical device space, you know there is a ton of noise surrounding this stock right now, so we really need to lock in on the fundamentals.
So here's our roadmap for today. First, the Avanos snapshot and hook. Second, the Warren Buffett lens. Third, the Peter Lynch lens. Fourth, the Benjamin Graham lens. Fifth, DCF and market multiples. And finally, number 6, synthesis and final verdict. Let's get right into it.
Section 1. Avanos Snapshot and Hook. Right now, Avanos is sitting at a current price of $24.94. But here's the massive kicker, the thing you can't ignore. There is a $1.272 billion enterprise value acquisition offer from American Industrial Partners currently on the table. So as investors and analysts, we have to ask an absolutely critical question here. Is this stock a hidden gem, or is it a complete value trap? I mean, do the underlying fundamentals actually back up that price tag if, for some reason, the buyout falls through? Let's look at the company snapshot. Avanos makes vital medical devices primarily focused on specialty nutrition systems. Think of things like their Mickey enteral feeding tubes and pain management and recovery products like their non-opioid pain pumps and CoolLeaf systems. To give you some context on their scale, they just posted $182.2 million in Q1 2026 revenue. That actually represents a solid 8.8% year-over-year growth, which, by the way, beat expectations. But here is the elephant in the room. Over the last 5 years, Avanos' stock has steadily declined. It dropped pretty significantly from 2020 to 2025, and this was all while the broader S&P Midcap 400 and the Healthcare Equipment Index were steadily rising. This long-term underperformance is exactly why this pending buyout is just absolutely crucial to current investors. Section 2. The Warren Buffett Lens. As you probably know, Buffett's entire philosophy hinges on the concept of an economic moat. You know, that structural advantage that protects your market share from competitors. Alongside a strong moat, he demands consistent earnings, manageable debt, and a really solid return on equity. Essentially, he wants a predictable, owner-earnings-generating machine that he can buy with a comfortable margin of safety. So, weighing their competitive advantages against their risks, well, Avanos does have some moat strengths for sure. They've got strong patent protections stretching all the way out to 2047, and they command a leading market share with those Mickey feeding tubes. However, the risks on the other side are substantial. They face heavy competition from absolute giants like Boston Scientific and Medtronic. Plus, their earnings consistency is a real headache. I mean, they just logged a negative $16.6 million in Q1 free cash flow. If we try to calculate an intrinsic value for Buffett, that negative Q1 cash flow throws a massive wrench in the math. We actually have to normalize their cash flow using their $21.8 million Q1 adjusted EBITDA just to find an approximate annualized owner earnings. When we do that, Buffett's intrinsic value lands near $15 a share. Apply his strict 30% margin of safety, and that gives us a firm buy limit of just $10.50. So at nearly $25 today, yeah, Buffett takes a hard pass.
Section 3. The Peter Lynch Lens.
Okay, so which of Lynch's 6 famous categories does Avanos actually fall into? Well, given their recent strategic moves, they divested their respiratory health business for $110 million, sold off their HA product line, and acquired Nexus Medical to pivot into vascular access. Avanos leans heavily into the turnaround category. Management is actively trying to reimagine the whole business model to get profitability back on track.
Now, Lynch loves a strong balance sheet, and Avanos actually delivers there. They have $65.6 million in cash against a very manageable $98.2 million in debt. They even boast double-digit organic growth in specialty nutrition. But here's the real kicker, the PEG ratio. With an annualized EPS of just 44 cents against a $25 stock, you get a PE ratio of roughly 56. Divide that by management's projected 5% mid-single-digit growth, and wow, you get a PEG ratio of 11.2.
In Lynch's playbook, a PEG ratio of 11.2 is just wildly expensive. Remember, he looks for a PEG ratio of 1.0 or lower to signify you're getting growth at a reasonable price. Because of that, his framework triggers a hard sell at current market levels. For Avanos to reach that magical 1.0 PEG based on their current growth rate, the stock price would literally have to plummet to $4.40. Let that sink in.
Section 4. The Benjamin Graham Lens.
So, the first two gurus walked away. Let's run Avanos through Graham's strict defensive investor checklist. It's a bit of a mixed bag, honestly. They easily passed the adequate size test with over $1 billion in enterprise value. They have a rock-solid balance sheet, $325 million in current assets easily covering their current liabilities, so they pass there too. But then it falls apart. They completely fail on earnings stability, they fail on the dividend record because they have no intention of paying one, and their PE multiple is well over Graham's maximum of 15, so that's another fail.
Even though they failed the checklist, we can still calculate their hard asset value using Graham's famous intrinsic value formula. It's pretty straightforward. You multiply 22.5 by the earnings per share and the book value per share, and then take the square root. We plug in that annualized 44-cent EPS, and we calculate a book value per share of $16.81, which we get from their $782 million in total stockholders' equity.
Running that math, Graham's formula yields an intrinsic value of just $12.90. This means a strict value investor following Graham's principles wouldn't even think about touching this stock today. In fact, just to secure Graham's standard margin of safety, the stock would need to drop down to a $9.03 buy limit.
Section 5. DCF and market multiples. Let's move into modern valuation.
To build a fair discounted cash flow model, we actually have to make some adjustments. As we mentioned, real-world Q1 free cash flow was negative, but this was largely due to a massive $30 million hit from expected syringe-related tariffs that management called out in their earnings call. So to be fair, we must assume a normalized $70 million starting point based on their adjusted EBITDA to build a realistic baseline. From there, we'll project 5% growth over 5 years, use a standard 2% terminal growth rate, and discount it all back by a 9% weighted average cost of capital.
Notice how incredibly sensitive the model is to even minor changes in these assumptions. But looking at our base case right in the middle, a 9% discount rate and 2% terminal growth, the model lands at a $23.80 fair value per share. Finally, a metric that's getting close to the current market price.
If we apply a secondary modern model, an EV to EBITDA comparable analysis, and look at peers like Baxter International and Henry Schein, Avanos currently trades at about a 13.6x multiple. The peer average, however, is closer to 15x. If Avanos traded at parity with its peers, it actually generates an implied fair value of about $27 per share.
Section 6. Synthesis and final verdict. Let's bring it all together. Blending all these numbers together, you can see a very stark divide. The historical value gurus, Buffett, Lynch, and Graham, see a company where the fundamental value is dragged way down by inconsistent earnings and high multiples. They value it significantly lower than its current trading price. On the flip side, the modern DCF and market multiples, which factor in peer comparisons and normalized cash flow adjustments, place the fair value right around that current $24 to $27 range. Because of this data, our final verdict as an analyst is a firm hold. The current $24.94 price is almost entirely anchored, literally propped up, by the pending $1.272 billion IEP buyout. The market is basically pricing in the deal's success right now. But here is the absolutely critical takeaway I want to leave you with. If that regulatory approval fails or the deal somehow falls through, the historical gurus show us exactly how far the stock could plummet based purely on its current fundamentals. So the question is, are you prepared for where this stock will land if the deal breaks?